Something's happened over the last year that I never thought I'd see in my career. And that is, I'll name off a bunch of the states here: Alaska, Idaho, Texas, Nevada, Utah, Wyoming, Missouri, Kansas, Oklahoma, Arkansas, North Carolina, and a few others have passed legislation saying, you know what, this is a legal tender coin. And some of the states say only American made. Most say any sovereign mint coin issued by a government, mint past or present, would be considered legal tender within the state for all debts, public and private, including paying your property tax. Now, the law reads that it will be the value, the melt value plus any market premium. The U.S. Eagle has a $1 face value on the silver coin and a 50 on the gold. Obviously, neither are going to come into play when you're using them. But the fact that this has actually been passed and is now law in these states blew my mind. I kind of feel it's best to have 1 ounce coins made by the U.S. Mint if possible. And for the first time in almost 4 years, the premiums have come down to a level that I'm comfortable selling them. And I'm one of only 27 U.S. Mint authorized resellers in the world. I've told everyone for the last 3 years they're too expensive. Don't buy them. Until now, they've come to a level that I am comfortable recommending. And if I had one choice to buy, it would be 1 ounce gold Eagles and 1 ounce silver Eagles, maybe 1 ounce gold Buffaloes as well. And that's it. You know, my whole career, John, I always spoke to cost averaging because it is the only way to truly smooth out the uncertainty curve.
Right.
You know, I guess you have to ask yourself, there's a term that I've become very fond of called logarithmic decay, which says little by little by little by little by little by little by little, I'm paying all at once. It's like the Niagara Falls, you know, little by little, the pitch changes, little by little by little. By, you can look at social aspects, you can look at economic aspects, all of the things. Where are we on the curve? And I would say if you're starting to feel we're getting close to the falls, then no, cost averaging is not the way to do it. Gold and silver are not an investment. They're wealth. They're wealth that has outlived German hyperinflation, the Great Depression. Gold is still immutable wealth. And to me, as we go through this discussion, I want people to understand that it isn't an investment to me. It is wealth. And the most sophisticated, biggest money on the planet, that being the central banks, agree with me because over the last 18 months, they've bought more than at any time in history. And you go back to 2019, the central bank, the Bank of International Settlements, reclassified it as the world's only other Tier 1 reserve asset. So it is a very important asset and growing more so by the day. The greatest gift I've ever been given in my life was my father telling me I'll buy something every 2 weeks or he'll fire me. He taught me how to pay myself first. You know, Robert's game, get out of the rat race. Yeah. You'll never get out of the rat race if you don't pay yourself first. You will never get out if you don't pay yourself first. I don't care if it's a $10 bill in a mason jar or a 1 ounce silver eagle in your drawer. Let the laws of compounding work for you instead of against you. And it's very, very important to always pay yourself first, be methodical on it, and be very regimented about it, and be angry at yourself if you skip. Double up the next time. Because it allows you, look, success is built not on debt and leverage. It's built on savings, investment, and reinvestment. And you have to save and invest in yourself and reinvest in yourself, but continue to pay yourself first. That's the most important. So every person I've hired in my company, almost all of them are friends going back to Little League. I mean, literally, I have 14 brokers, and they're all my friends since elementary and junior high. And I said to him the same thing my dad said: you want a job? Fine, you'll buy something every 2 weeks, and do not let me ever find out that you didn't do it, because there's going to be a problem. It's the only problem we will have. And every single one of them say to me, I love you, thank you, thank you. Cost average when you can, when you have that luxury. But if you don't have any and you've been waiting for a pullback or whatnot, look around the world and look at what's happening and the speed at which it's accelerating. Every day it's something new. When I started doing these podcasts, it was little by little by little. Now it's little by little by little by little. Every single day there's another piece of the Jenga tower that gets pulled out. What's the piece that's going to knock it down? Don't know. But I would always say for 30 plus years cost average, I think we're running rapidly close to out of the luxury of that type of timing. So I'll leave that up to your listeners to decide where we are and where they are in their own personal stance. But I don't have a problem with cost averaging. I just think it's getting a little late in the day to try and get cute in terms of building a portfolio. Belt Road Initiative. the largest infrastructure project in human history that the United States is not part of. It's China's attempt to connect Asia, South America, Africa, and parts of Europe. 175 countries or so are on it. Represents 75% of human population, 50% of global GDP right now. That's not even talking about the BRICS or the Shanghai Cooperation Organization or any of these other groups that Saudi Arabia is part of. But the fact that all the OPEC countries are on the Belt Road, you could see a time where Saudi Arabia says, hey, thank you. We appreciate the 50 years of protection, but now we are with the BRICS. We are in the Shanghai Cooperation Organization, which is the largest regional military and financial organization in the world. We signed a protection agreement with Russia. We told the BRICS New Development Bank that we want in. And by the way, we told everyone in Davos we're open to taking new other currencies for oil. So if that happens and they say, you know what, we're not going to take dollars anymore because you guys are going green anyway, right? Bang, just like that. The whole world has incentive to dump dollars. And when the dollars get dumped and they hit our shore, creating a tsunami of inflation, the byproduct of that is interest rates that go to the moon. We have more debt right now to the point where the largest amount of student debt ever, the largest amount of mortgage debt ever, the largest amount of household debt, 17 trillion ever, the largest amount of credit card debt ever, 1 trillion. 65% of the country paycheck to paycheck, 45% of the country earning over 100 grand, paycheck to paycheck. So interest rates spike to the moon, the dollar gets dumped. The inverse of spiked interest rates are collapsing stocks, bonds, and real estate prices. The dollar gets dumped. There is your great reset. Bang, like that, everything resets. It is the reset. It's the reset that Klaus Schwab talked about. It's the reset that Thomas Jefferson talked about 300 years ago when he said, if we allow a central bank to control our money supply, first by inflation, well, we've seen that. More money created in the history of the country over the last 4 years than in all the years before, and then by deflation. You'll end up renting the land back from our forefathers or renting the land that our forefathers conquered. It's something like that. And he's right. Now we're going to see a deflating economy, a recession, higher interest rates, difficulty paying off the debt, and bang, you don't own anything anymore. You rent. People do not have the ability to get out of the way of what they don't see coming. And most people are reluctant to listen to this type of message because it speaks of anything but good times and prosperity. And that's why so few people ever succeed in investing, because they don't see the big picture. They only move after they see it for themselves. And in this case, why so few people will be prepared, because they are reluctant to believe that normalcy bias could ever change. But the clues are there. The crumbs are there. You don't have to be a PhD economist or be even particularly astute if you put together the clues. When you look at each and one of these pieces in and of themselves, yeah, they might be disturbing. Put them all together and then take a step back and say,